Hello, everyone, and welcome to another episode of Coffee with Carl. I am your host, Carl Zoellner. I'm one of the attorneys with Anderson Business Advisors. And as you can see by our background today, we are going to be talking about cryptocurrency. I'm going to do this one in two parts. I want to go over some of the basics in part one. And then on part two, I'm going to hit on some of the new guidance the IRS has put out about cryptocurrency, and so as sort of an update. So we're going to do this in a two-part series because, as you know, I like to keep these short so that way you can split them up and look at them. So starting out, cryptocurrency. Most common, it's become more popular once again, so it's tended to go through cycles. About this time last year and the year before, it was very popular, and then all of a sudden the price dropped and it became less popular. Now again, it's starting to peak up again. People are starting to reinvest. We're looking at all sorts of different types of cryptocurrency investment. Most commonly, we're looking at cryptocurrency investors. We're looking at folks who maybe do mining, which is basically the gathering of cryptocurrency by maintaining the blockchain. There's mining machines. There's all sorts of ways. There's cloud mining. There's all sorts of ways to generate income from that. Income generated from cloud mining or mining in general is going to be tagged as active income, meaning it's going to be coming through when you earn. That money is going to come through at your individual tax rate, which is in the, all the way from 0 to 10 to 12 to 20, 22, 24, 32, 35, or 37%, depending on how much money you earned and scaled through those categories, plus the 15.3% self-employment tax for those mining operations. Now, when we talk about cryptocurrency investing, there's ways that you can just purchase the coins or trade them almost like stock. This is actually probably the most common way people are using cryptocurrency these days. And just like stock, the IRS treats cryptocurrency as property. So the name is sort of misleading in that from the IRS's perspective, because IRS does not treat the trade of cryptocurrency like currency from the tax perspective, but rather treats it like property, more like stock. Normally when we're looking at stock or even cryptocurrency, we are now focused on then short-term versus long-term capital gain, since it is property. So for my real estate investors out there or stock traders out there, you'll actually be fairly familiar with the type of tax treatment you should expect if you're investing in cryptocurrency. Generally, the difference between long and short-term capital gains from a timeline perspective, short-term capital gains are investments that take place in property that are usually a year or less, and for long-term, we're looking at a year or more than a year. So if you hold your cryptocurrency for more than a year before you sell it, you're looking at your long-term capital gains rates versus short-term. Short-term capital gains rates, you're looking at those numbers I mentioned earlier, except without the 15.3% self-employment tax, or technically adjusted the 14.13%, but that is the difference. So short-term capital gain rates, just as a review, 10, 12, 22, 24, 32, 35, and 37%, depending on how much income you generate. On average, I would say our clients are normally in the 22 to 32% bracket. However, there are those that, of course, that scale up to the 35s and 37s, and then there are the ones that are on the other end, maybe just starting out, that are in the 10 to 12% range. Now, long-term capital gains rates. So let's talk about if I say bought a Bitcoin and held it for more than a year and then decided to cash it out. When I take that money, now I'm looking at long-term capital gains rates. Now, long-term capital gains rates are more favorable than your short-term capital gains rates. Still does not come along with the self-employment tax, which is nice, but for the long-term capital gains rates, we're usually looking at 0, 15, or 20% on what percentage you would pay on that income. Most common bracket, because it covers the most, quite frankly, the most amount of money or the widest range of income, is going to be your 15% range. However, a lot of folks, we can get you to fit into the 0% range, and then some of my highest net income earners may be looking at that 20% range. So this is an initial video on just sort of talking about the tax implications of trading cryptocurrency. Part 2, we're going to go into some of the IRS guidance that has come out recently on trading cryptocurrency and what qualifies as a taxable event when you're trading cryptocurrency. Once again, I'm Carl Zoellner with Anderson Business Advisors. For our existing clients, always happy to hop on a call with you if you want to talk a little bit more about alternative investments, as well as a ton of advisors standing by for anybody who else is interested who may not be a client yet and interested in getting some more information as well. So once again, we put out a ton of free content. I always invite you to consume that content, share with friends, and like I said, if you ever want an individualized consult, give us a call anytime. Thanks. See you on the next episode.